Welcome to The Deep Dive, the show that extracts the crucial knowledge from complex source material, giving you the shortcut to being truly well-informed. Today, we are staring down really one of the most significant and unavoidable technological deadlines in human history.
We're talking about Q-Day, and this isn't science fiction anymore, not at all. It's the projected moment when a sufficiently powerful quantum computer will break the fundamental encryption that secures, well, almost everything.
Everything. Your bank accounts, national power grids, military communications.
It's all vulnerable, and the scary part is we're getting closer to that day.
And the government knows it. They're not waiting around for this existential threat to just materialize. The U.S. has already established mandatory federal deadlines, some starting as soon as 2027.
Right. They're forcing agencies, critical infrastructure, everyone to migrate to quantum-resistant security. And that necessity, it's created a multi-billion-dollar non-discretionary market literally overnight.
Which brings us to our focus company today, SEALSQ Corp. You'll find them on the NASDAQ under the ticker LAES.
They're a small, Swiss-based semiconductor company, but they're built on this decades-old technical pedigree, and now they are claiming that they hold the actual hardware key, the solution to this looming post-quantum security problem, and they claim they have it right now.
So here is the central paradox, right? This is the ultimate tease that defines this entire deep dive.
Well, yeah.
LAES is fighting for a market that's expected to grow well beyond $40 billion. And they have what you could only call a fortress balance sheet.
It's staggering. Over $121 million in cash.
Yeah.
For a company this size, that's a massive safety net.
And yet,
Yeah.
the market has priced them for absolute flawless perfection.
I mean, it's trading at a stratospheric price-to-sales ratio of 72. It's a battleground stock in the purest sense of the word.
Priced as though they've already won, even though they're fighting against Goliaths. So our mission today is to dive deep into the sources on LAES, ticker LAES, which recently closed at $4.49 a share. We need to cut through the hype, analyze their tech, scrutinize the financials, and figure out if this aggressive pivot can possibly justify that extreme valuation.
Yeah.
Or if the bears, who are already circling, have the stronger argument.
Chapters 1 to 3, business, management, and financials.
Business understanding.
Let's begin by establishing the foundation of SEALSQ. I mean, the current public company, LAES, is pretty new, right? It only listed in May of 2023.
Right, but focusing just on that date is really misleading. It misses the whole context.
How so?
The company's technical core is not a startup, not by a long shot. It was forged from veterans of secure microcontroller divisions at industry giants. We're talking Motorola, Atmel, Inside Secure.
So these aren't new kids on the block.
Not at all. We are talking about a technical team with a 25-year pedigree in digital identity and hardware security.
And that pedigree, I guess, that explains the massive historical scale the company loves to cite. They say their tech has secured over 1.75 billion devices globally.
Which is a monumental reach. It confirms their foundational expertise is legitimate. They know what they're doing.
But, and this is the massive disconnect you pointed out in the intro, that historical scale is completely divorced from their current financial reality.
It really is. The legacy low-margin business generated only about $11 million in revenue for the entire fiscal year of 2024. The whole investment thesis today, it's entirely reliant on a complete rapid pivot away from those old chips.
A pivot into high-margin, next-generation post-quantum cryptography, or PQC, solutions.
That's the whole game.
Okay, let's unpack their business model because it seems pretty complex, but also highly strategic. It's the classic razor and blade structure, right? But for security.
It is. And it's designed specifically to do two things: capture recurring revenue and impose incredibly high switching costs. They have 4 primary revenue streams.
Okay, what's the first one?
First, you have the razor itself, standard product sales. These are their secure semiconductor chips, the historical Voltic line. But more importantly, the new PQC-enabled line.
So they sell you the physical chip one time. What are the services?
Yeah.
You know, the sticky blades that lock the customer in?
Right, the blades. The first is firmware licensing. This is basically selling access to their proprietary crypto IP. The second is secure provisioning.
Secure provisioning? What's that?
It's a critical one-time fee they charge the factory. They inject a unique hardware-based digital identity, what they call a root of trust, directly onto the silicon of every single chip before it even leaves the factory.
And that root of trust is the foundational identity marker. It's what allows the device to be authenticated later on, right?
Precisely. And that leads to the third and most valuable blade, recurring service revenue. This comes through their Managed Public Key Infrastructure, or PKI, platform. They call it INAS.
I see. So the INS platform handles the whole life cycle of that identity.
Exactly. Validation, revocation, key management, and crucially, those over-the-air updates for millions of device identities in the field.
So let's say you're an automotive manufacturer, or maybe a utility company deploying millions of smart meters. You buy the chips from LAES, but once your whole fleet of devices is relying on that INS platform to verify every device.
The cost and the risk of ripping and replacing that entire foundational identity layer to move to a competitor, it becomes prohibitively expensive.
It creates a tremendous moat.
A huge one.
Yeah.
They use the hardware as the initial wedge, but the real value, the real money, is captured through the high-margin recurring software and services revenue for the entire lifespan of that device. And that could be 5, 10, even 15 years in some industrial applications.
This brings us to their crown jewel then, the QUANTUM SHIELD QS7001. This is the product that's supposed to drive that 50 to 100% growth we talked about.
This chip is their central strategic advantage. It was announced for launch in mid-November 2025. And their claim is, well, it's a big one.
What are they claiming?
They assert the QS7001 is the world's first secure chip that fully embeds the newly standardized PQC algorithms, specifically Crystal's Kyber and Crystal's dilithium, directly into the silicon hardware.
Okay, so why is embedding it in the hardware such a breakthrough compared to, say, a software solution? This is where the technical complexity really matters for the security advantage.
It's the difference between building a fortress and, just putting a new lock on a wooden door. It's fundamental defense versus a bolted-on patch.
So what are the competitors doing?
Many competitors, the Goliaths we mentioned, they rely on either software-based PQC or maybe hardware accelerators that still manage the cryptography through software. SEALSQ argues pretty persuasively that any software layer is inherently susceptible to a side-channel attack.
Hold on, let's quickly define a side-channel attack for the listener. What is that?
A side-channel attack is a really clever form of non-invasive attack. The attacker doesn't need to physically hack the device or break the encryption with math. Instead, they exploit indirect information that leaks from the device during the cryptographic process.
What kind of information?
Things like the precise time it takes to run an encryption calculation, the device's power consumption patterns, or even the faint electromagnetic emissions it gives off.
That's fascinating. So by just timing a calculation or monitoring a power fluctuation, an attacker can literally figure out the secret cryptographic key.
Exactly. Since a software version executes variable instructions based on the data it's processing, these little side channels become visible. But by embedding the PQC algorithms directly into the silicon logic gates, SEALSQ claims the physical and temporal signatures of the operation become constant. It makes it exponentially harder to extract the key.
So it provides better performance, it's tamper-proof.
And they claim it is up to 10 times faster than software-based PQC.
So their whole value proposition is future-proof, faster, and certified security at the foundational hardware level. And this level of protection is required to hit the highest certifications, right? Things like the common criteria EAL5 plus.
Yes, and that certification is absolutely necessary for sensitive governmental and defense contracts. It places them squarely in the high-security, high-margin, mission-critical end of the market, where cost is secondary to assurance.
Okay, now let's zoom out to the industry tailwinds. This entire investment story is driven by the inevitability of Q-Day. It's creating this powerful, non-discretionary market, and we have to grasp the colossal scale of this.
We really do. And you need to contrast two crucial financial figures here. The first is $357.6 billion.
Okay, what's that?
That is the estimated total addressable market, or TAM. It's the value of all current systems using vulnerable encryption that must eventually be upgraded. And some sources project this could grow into the trillions by the next decade.
And what's the small figure that shows where we are today?
$2 billion. That's the serviceable addressable market, or SAM. That's the amount companies are actually spending on PQC solutions right now.
So the entire LAES thesis is just a bet on the rapid convergence of that small $2 billion spending pool with the massive $357 billion vulnerability pool.
That's it in a nutshell. And the urgency is confirmed by the growth rate. The post-quantum cryptography market is forecast to grow at an incredible compound annual growth rate, a CAGR of somewhere between 39.5% to 40.2%.
That is explosive growth. It really confirms the panic and the necessity in the market.
And crucially, this is not demand driven by, consumer desire. It's driven by mandate. The largest catalyst is the U.S. regulatory push. NIST, the National Institute of Standards and Technology, they finalized the first official PQC standards in August 2024.
And that provides the technology standard the whole industry needs to follow.
Exactly. But the real urgency comes from the U.S. government agencies themselves. Policies like the NSA's CNSA 2.0 and the OMB Memorandum M2302, they require federal agencies to identify vulnerable systems and start the migration to PQC by deadlines beginning in 2027.
So that translates to guaranteed high-margin demand for compliant solutions. If you're a defense contractor or a supplier of critical infrastructure equipment or any company that deals with federal data.
You must migrate to PQC within the next 2 to 4 years. It's not optional. And this external pressure significantly de-risks the demand side for companies like SEALSQ that claim they're compliant.
But we can't ignore the competitive landscape. I mean, SEALSQ is truly a David facing multiple Goliaths.
They really are. The giants are the incumbent semiconductor manufacturers, Infineon, NXP Semiconductors, and Microchip. They have immense scale, research budgets in the billions, established supply chains.
And crucially, massive existing customer relationships across automotive, industrial, and defense.
Right. And their biggest threat is that these Goliaths can simply bundle PQC features onto existing chip orders. They could effectively use PQC as a loss leader just to maintain their market share.
Squeezing out small, specialized players like SEALSQ for price.
Potentially, yes. However, this is where SEALSQ leverages the barriers to entry. The primary challenge for the Goliaths isn't necessarily the technology. They can build the chips. The challenge is implementation and, more importantly, talent.
The talent shortage.
Integrating PQC is fundamentally difficult, and the single biggest hurdle cited by 40% of organizations globally is a profound lack of skilled personnel.
That is critical. So it's the global talent shortage that SEALSQ is looking to monetize, right? If companies can't hire the experts to integrate PQC, they have to pay an external service provider who already has the specialized team.
Exactly. And that brings us neatly into Chapter 2, where we look at how management has strategically addressed this exact talent gap. That specialization in solving complexity is the key to differentiating themselves from the massive scale of the incumbents.
Management evaluation.
We pivot now from the massive government-mandated opportunity to the leadership team that's tasked with navigating this highly volatile, high-stakes pivot.
And the leadership duality at SEALSQ is just fascinating. On one hand, you have the CEO, Carlos Moreira. He's a high-profile, highly visible figure.
Oh, absolutely. He's a regular keynote speaker at influential global platforms. The World Economic Forum, the United Nations. He's often talking about cybersecurity, AI, digital identity. He clearly has the promotional ability and the global network to sell a grand vision.
But if you look just at the data reflecting stability, a sort of discrepancy appears. Our sources show a really low average tenure for management.
It's only 1.8 years for management, and board tenure is just 2.7 years. In a traditional company, that would spell instability. It would be a big red flag.
But the context here kind of resolves this. The low tenure reflects the company's new public structure, having listed in 2023. This is a deliberate startup with a pedigree.
Right. They've taken a veteran technical core, given it fresh capital, and rebranded it under a high-profile CEO. The challenge for investors is figuring out if that technical core is truly driving the execution, or if the high-profile CEO is just driving the hype.
Well, the communication style certainly leans into the hype. The company is exceptionally promotional. They issue a rapid succession of press releases.
We noted at least 5 just in the first half of November 2025 alone. They're detailing partnerships with high-visibility groups like the BWT Alpine F1 team and various branches of the Swiss Armed Forces.
So the bull case would say this promotion is essential. You have to educate a fragmented market about a complex mandatory technology like PQC.
Right. But the bear case argues this is just excessive hype generation, designed to support the narrative of a volatile story stock.
And we have to acknowledge that the CEO, Carlos Moreira, is cited as being controversial online, which is a factor that, feeds the skepticism among sophisticated investors and contributes directly to that high short interest we'll get into later.
That's right. Highly visible, promotional leadership. It often attracts more scrutiny and more bears.
Let's turn to capital allocation. This is where the rubber meets the road. They are, appropriately, pursuing an aggressive growth strategy. No dividend. The yield is 0 because every dollar is being funneled back into future growth.
And the R&D budget confirms that. It's growing sharply, confirming their commitment to the QS7001 launch. They've allocated $7.2 million for 2025, which is up significantly from $5 million the year before.
But the most revealing move strategically was the cornerstone acquisition of ICALPS.
It absolutely was. They bought ICALPS for 12.5 million euros. And this wasn't a revenue play, which is a critical point.
So what exactly did they acquire?
They acquired a scarce, highly strategic asset, somewhere between 80 and 100 dedicated, highly skilled, application-specific integrated circuit, or ASIC design engineers.
ASIC design, that's creating specialized chips for specific jobs.
And these engineers are masters of custom silicon, exactly what you need for high-security PQC implementations. This acquisition is the direct mechanism by which LAES monetizes the industry's skills gap.
Right. If 40% of organizations can't implement PQC because they lack the people, SEALSQ now has a ready-made, highly profitable service team to sell custom PQC integration services.
And it's more than that. ICALPS brings immediate credibility and access to high-value sectors. They hold the ISO 26262 certification, which is mandatory for suppliers in the highly regulated automotive safety sector.
So this lets SEALSQ move from just selling off-the-shelf chips to generating high-margin revenue from custom design services for defense, automotive, and industrial clients.
Exactly. They also made another notable investment, $10 million in WISAT space. This wasn't just a random purchase. It's about securing a dedicated partner in the high-value satellite communications market.
Which is a key target area for early mandatory PQC adoption.
Right. It signals a proactive vertical integration strategy. They're trying to lock in those early pipeline wins.
Okay, finally, we should probably touch on the backward-looking returns, even though they're almost irrelevant for this kind of story stock.
They're abysmal, as you'd expect. Their TTM return on invested capital is negative 24.7% and ROI is negative 49.3%. But this is just the inherent reality of a growth pivot.
This is the necessary cost of building the razor and the blade infrastructure.
Precisamente. These massive negative returns are simply the ledger showing the cost of R&D, the ICALPS acquisition, and the WISAT investment. The entire investment case is a high-risk gamble that these negative returns today will rapidly pivot to substantial positive returns once the QS7001 is scaled and that high-margin PKI services revenue starts to compound.
Financial health.
Now we move to the financial structure. And the big question here is whether the cash runway is long enough to support this ambitious and very costly pivot.
The financial story is really defined by what we call the J-curve pivot. This term describes the shape of their revenue, a very sharp drop, followed by a projected aggressive rise.
And that drop was brutal. The company intentionally wound down its legacy business, and that resulted in revenue collapsing by a staggering 67%.
It really was. Revenue fell from $14.75 million in the first half of 2023 to just $4.83 million in the first half of 2024.
But this is crucial context, right? Management called 2024 a strategic transition period.
They basically told the market, we are killing the old business to bet everything on the new one. And the market, for the most part, accepted this volatility because the prize, that PQC first mover status, is so large. But it highlights the extreme fragility of their current revenue base.
So the stock's $737 million market cap.
Yeah.
It rests entirely on the new guidance. What is management projecting for the ramp-up?
They are projecting a monumental ramp-up in the second half of 2025 and beyond. Fiscal year 2025 revenue guidance is set aggressively between $17.5 and $20 million.
And if they hit the midpoint of that,
yeah,
what does that represent in terms of growth?
It represents 59 to 82% year-over-year growth, and the acceleration continues. They anticipate continued acceleration, projecting another 50 to 100% growth in 2026.
That's when the ICALPS services and the full volume of the QS7001 chips are expected to really hit the revenue line.
Yes. The market is not paying for $11 million in revenue. They are paying for that anticipated hypergrowth.
Okay, let's talk margins. Operating margins are deeply negative. TTM op margin is negative 269%, which is the expected cost of R&D and scaling.
Yeah.
But gross margin is the key operational indicator here.
The gross margin is the canary in the coal mine, and right now it looks positive. Gross profit margin is improving sharply. It's risen from a meager 19% in the first half of 2024 to 34% in the first half of 2025.
And that shows that the new PQC products are inherently higher margin than the old legacy chips.
It does, and management is explicitly targeting a 45 to 50% GPM as the PQC services and hardware scale up. If they achieve that, it validates the entire razor and blade strategy.
Meaning the high-value service revenue dramatically improves profitability per unit of sale.
Right. But despite the strong margin outlook, the free cash flow is negative, and the cash burn is accelerating. They burned through nearly $12 million in 2024, and the burn rate accelerated significantly in 2025 to over $14 million in Q2 alone. That acceleration is the highest cost of this pivot.
Which is why we need to focus on their balance sheet, and it's truly exceptional for a company of this size.
Their financial health is a fortress. They have virtually no banked debt, an extraordinarily low debt-to-equity ratio, around 4.6%.
And the liquidity is fantastic. The current ratio, which measures short-term ability to pay liabilities, is 7.38, and anything above 2 is considered very healthy.
This health is all enabled by a massive cash pile of $121 million as of June 30th, 2025. This is the ultimate safety net. It means they have secured a financial runway of at least 2 years at the current accelerating burn rate.
That buys them the crucial time they need to execute the QS7001 launch and convert their pipeline without the immediate threat of insolvency or having to issue highly dilutive stock. Okay, now let's tackle the elephant in the room: valuation. We established that standard metrics like price to earnings are useless because the company is deeply unprofitable. Net losses grew to $21 million in 2024.
So we have to rely on price to sales, which measures market cap against trailing revenue. And the number is, well, it's shocking. Based on trailing 12 months revenue of about $11 million, the PS ratio is around 72.06.
72. That is an extreme valuation, even by the standards of a high-growth tech stock.
It implies that the market is applying a valuation that doesn't just anticipate the 2025 guidance. It fully prices in the entire conversion of their projected $175 million pipeline between 2026 and 2028. You're buying a highly aggressive future, not the present company.
So let's pause and really consider what a PS of 72 requires. To rationalize that number, the market has to believe two things. One, that LAES will achieve those massive 50 to 100% growth rates year after year for half a decade.
And two, that they will successfully hit their 45 to 50% gross margin target. And all of these assumptions, they have to be realized without delay, without major competitive pressure, and without a market correction. It leaves zero margin of safety.
Right. While we don't have a public DCF analysis, the research consensus, like the Investing Pro finding, confirms the stock is currently overvalued. Justifying this PS requires a level of perfection rarely seen in the market.
The financial structure is a tale of two extremes. A bulletproof balance sheet supporting a revenue profile that trades at a sky-high valuation. It's a profound gamble.
Okay, let's unpack this. The transition from a tiny legacy business to a massive PQC powerhouse demands a ruthless strategic execution. Before we move to market sentiment and risk, remember to show your support.
Like and subscribe to Stock Analytics AI.
And for those who want to go even deeper, for $4.99 a month, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
Chapters 4 to 7, Market Sentiment, Ownership, Risk, and Final Conclusion.
Markets.
Transitioning now to how the external market views this extremely polarized investment case, the great battle between that $121 million cash pile and the PS72 price tag.
Well, Wall Street coverage is exceptionally thin, which is pretty typical for a newly public small cap in a specialized sector like this. The official analyst consensus is a strong buy, but this is based on the opinion of a consensus of one analyst. It's barely a consensus at all.
The consensus of one, we have to take that with a mountain of salt. What is that single analyst's target?
The 12-month price target is set at $6, suggesting roughly 33% upside from the recent price of $4.49. However, the true sentiment of the sophisticated market isn't revealed by that single buy rating. It's revealed by the short interest.
This is the most crucial metric. Tell us about the short interest dynamic.
Short interest currently stands at 14.33% of the public float. That is an extremely high figure. It indicates a massive contingent of bears are actively betting on the stock's decline.
That figure confirms we're dealing with a classic battleground stock. The shorts see the extreme valuation, the negative profitability, and they see it as a fundamental weakness just waiting to collapse.
The bears are looking at the $11 million in revenue. They're noting the execution risk, and they're saying the PS ratio of 72 must revert to a more rational multiple, maybe closer to 10 or 15.
And the bulls?
The bulls, meanwhile, see the government mandate, the first mover PQC technology, and they're betting that the sheer volume of mandatory demand will force the stock higher, triggering a short squeeze.
Okay, explain that mechanism. When a stock has such high short interest, why does that create such extreme volatility?
Because if the company delivers even slightly unexpectedly strong news, say a major defense contract win tied to the QS7701, the short sellers are forced to rapidly buy back shares to cover their losing positions.
And that sudden surge in buying pressure, known as a short squeeze, can send the stock rocketing upward.
Exactly, entirely disconnected from underlying fundamentals. And that creates the extreme volatility we see in this stock.
Let's also look at the technical indicators that are guiding short-term traders. As of mid-November 2025, the short-term momentum appears to be negative.
That's right. The stock at 449 is trading below its 50-day simple moving average, which is in the $5 to $5.50 range. That's a classic bearish signal for short-term momentum.
But stepping back, the long-term trend remains positive.
It does. The stock is holding comfortably above its 200-day simple moving average, estimated around $3.60. Furthermore, the 50-day average crossed above the 200-day average, a golden cross, back in October 2025. That's a powerful long-term technical signal indicating sustained upward pressure.
So technically speaking, the stock is experiencing a short-term pullback or consolidation, likely fueled by that heavy short-selling pressure. But the underlying long-term trajectory is still pointing up. It's a fundamental struggle playing out on the charts.
Ownership structure.
Analyzing who actually owns SEALSQ stock provides vital context for its extreme volatility and that high PS ratio.
And the figure for institutional ownership is the first major red flag for conservative money managers.
It's shockingly low. Institutional ownership is just 3.45%. This means the vast majority of the smart money, the large mutual funds, pension funds, endowments, they're simply not involved.
Which strongly confirms the narrative that LAES is primarily a retail-driven stock. Its price movements are highly sensitive to retail sentiment, to news flow, to promotional efforts, rather than steady, fundamental accumulation by large, established funds.
The bull argument, of course, is that the stock is merely undiscovered, and that once the PQC revenue ramps up and the company demonstrates sustained profitability, these institutions will be forced to buy in, creating tremendous upward pressure.
But for now, their avoidance signals profound concern, either about the valuation, the lack of profits, or the execution risk.
All of the above, probably.
We also have to address the massive anomaly regarding insider holdings. Initial SEC reports suggest 0% insider ownership, which, if that were true, would be a fatal red flag. It would imply zero alignment between management and shareholders.
Right, but we need to explain why that 0% figure is misleading. SEALSQ is registered as a foreign private issuer, an FPI, because it's headquartered in Switzerland.
And that designation, what does it do?
It exempts its insiders from the standard periodic SEC filing requirements, Forms 3, 4, and 5, that mandate public disclosure of insider stock transactions and holdings.
So the figure is a reporting artifact. It's a data gap. We simply cannot determine the true level of insider ownership from the available public data.
Exactly. And while this means we lack certainty on management alignment, it thankfully doesn't confirm the worst-case scenario of zero skin in the game.
So with minimal institutional presence.
The vast majority of the public float is held by individual retail investors. This concentration is the engine driving the high volatility, and it fuels that intense short squeeze potential we discussed earlier.
Risk assessment.
Okay, let's systematically break down the internal strengths and external threats using a SWOT framework. We'll focus on the material facts that will determine whether SEALSQ can grow into its staggering valuation.
Let's start with strengths. The internal moats that give SEALSQ a fighting chance. The primary strength is the technology and the claim of first-mover advantage. The world's first PQC hardware chip, the QS7001.
Offering that superior speed and side-channel attack mitigation?
Correct. Second is the financial safety net, the one thing that provides breathing room. The fortress balance sheet. $121 million in cash, almost no debt. This is not just a runway, it's protection against the need for immediate dilutive capital raises.
Third is the specialized human capital. That ICALPS acquisition secured 80 to 100 highly skilled ASIC design engineers,
giving them the unique ability to monetize the industry's skills gap by offering high-margin custom design services for automotive and defense clients.
And finally, the structural moat, the razor and blade business model, designed specifically to ensure high switching costs once a customer's foundational root of trust is integrated into their fleet of devices.
Now for the weaknesses. the internal limitations that the bears are focused on. The most immediate is the lack of profitability, accelerating cash burn, and those growing net losses. 21 million in 2024.
The second is extreme dependence on execution. That 67% revenue collapse shows the legacy business is now a ghost. The company's future success is entirely dependent on the successful, timely launch, certification, and rapid market adoption of the new PQC products.
And this feeds directly into the third weakness, the zero margin of safety offered by that extreme PS valuation of 72. Any execution delay, any chip defect, or any failure to convert that $175 million pipeline will be brutally punished by the market.
Okay, let's look at the opportunities, the external tailwinds they are riding.
The most powerful one is the regulatory opportunity. You have guaranteed, non-discretionary market creation fueled by the NIST standardization and the U.S. government mandates like CNSA 2.0. The government is essentially telling the industry, migrate or die.
They also have the immediate high-margin opportunity to sell their expertise through the ASIC design services from the IC-ALPS team, moving them up the value chain.
Yes, but the truly strategic opportunity is geopolitical. The ongoing U.S.-China technological rivalry has created massive demand among U.S. defense and government contractors for trusted suppliers, verifiable non-Chinese technology.
And SEALSQ, a Swiss company, is actively leaning into this with their Made in USA pivot. Tell us more about that pivot. What does Made in USA actually entail for them?
It means establishing U.S.-based operations for the root of trust and for their personalization centers. This strategy is specifically designed to meet stringent U.S. defense procurement rules. It positions them as a trusted domestic partner to capture the most lucrative, secure contracts tied to those 2027 deadlines.
That brings us to the external threats that could derail the entire story.
The biggest threat remains the entrenched giants, NXP, Infineon, and Microchip. They have the financial firepower and the customer relationships to flood the market with cheap, bundled PQC solutions, potentially undermining LAES's ability to command a premium price.
Second is just pure execution risk. The high short interest is essentially a collective financial bet that the $175 million pipeline will not convert into profitable revenue, or that the QS7001 will be delayed.
And we also have to address the broader macroeconomic fit, the higher for longer interest rate environment prevailing in late 2025. This environment is highly detrimental, toxic, even to high-gross, unprofitable companies like SEALSQ.
Why does a high interest rate environment specifically threaten a high PS stock?
Because LAES's entire valuation is based on cash flows they are expected to generate far in the future in 2028, 2029, and beyond, when the PQC market fully matures and they are, hopefully, highly profitable.
And in valuation models, high interest rates translate directly into a high discount rate.
Right. And a high discount rate means those distant future earnings are worth dramatically less today.
So when the market is applying a high discount rate, a PS of 72 becomes incredibly hard to justify.
It puts immense constant downward pressure on the stock price and forces the company to demonstrate a path to profitability much sooner than originally anticipated.
And finally, we noted a geopolitical headwind that explains the urgency behind their Made in USA pivot.
Yes. Despite the tailwind from the U.S.-China tech war, U.S. trade policy has introduced new America First tariffs. And sources reported a significant new tariff, up to 39% on most Swiss exports to the U.S.
A 39% tariff would instantly destroy their price competitiveness in the U.S. market, especially for defense contracts.
Correct. The Made in USA pivot is therefore not just an opportunity, it's a necessary defensive move to bypass that direct tariff threat. It ensures they can actually compete for the mandatory U.S. government contracts starting in 2027. It's a strategic necessity born of external pressure. Okay, let's synthesize everything we found. SEALSQ Corp is fundamentally defined by the extreme conflict between its compelling narrative and its daunting financial burden. Let's start with the compelling bull case.
The bull case is simple and it's powerful. LAES is one of the world's only pure-play investments in a 40% ACR government-mandated market transition. The demand is not optional. That 2027 catalyst is real.
And they possess critical technical and capability moats. The QS7001 is a genuine first-mover hardware solution, and that specialized IC-ALPS ASIC design team addresses the industry's single largest pain point, the skills shortage.
And most critically, they have the financial runway to execute this risky pivot. That $121 million cash fortress provides at least 2 years of time to convert their pipeline without immediate fear of dilution or insolvency.
Okay, now for the bear case, which focuses entirely on financial reality and execution risk.
The valuation is aggressively detached from current revenue. A price-to-sales ratio of 72 for a company with negative profitability requires perfect, flawless, multi-year execution. There is zero margin for error.
And market skepticism is massive. It's evidenced by that 14.33% short interest. This is a story stock, confirmed by the minuscule 3.45% institutional ownership. It means the price is highly volatile and driven by retail sentiment, not fundamental accumulation.
And the competitive threat from giants like NXP and Infineon, who can leverage their scale and existing relationships to crush a small player, that cannot be ignored.
Ultimately, the current price is a profound financial bet on the future. It's not a valuation of the $11 million business of today. It requires accepting highly aggressive 50 to 100% multi-year growth assumptions, significant margin expansion, and a favorable shift in macroeconomic conditions to justify.
So LAES sits right at the center of this battleground. Technological optimism about securing the digital world colliding with extreme financial skepticism fueled by high cash burn and a valuation that prices in every single future success imaginable.
So the central conflict for you, the learner, isn't whether the technology works, but whether the company's timing can beat the government deadlines and the massive incumbents. Given the mandatory 2027 deadlines for PQC migration, the provocative thought is this. Can SEALSQ execute its pivot and convert its $175 million pipeline before its cash runway expires, or before the massive incumbent Goliaths leverage their scale and their bundled solutions to dominate the market?
It's an incredible race against the clock for a small player trying to solve colossal global problems.
Like and subscribe to Stock Analytics AI.
For $4.999, get 500-plus deep dive videos on all S&P 500 stocks, with NASDAQ 100 coming next, plus members-only requested deep dives.
This analysis was generated by an AI system for educational purposes and should not be considered financial advice. Please conduct your own research or consult with a qualified financial advisor before making any investment decisions. Thank you for diving deep with us.